Hello and welcome to Trading 5 Talents. This video is going to be showing an improvement to my previous Iron Condor strategy, and I'll show you how we can potentially improve our profits by selling these Iron Condors. So if you've missed the previous videos, what I'm doing is I'm improving on the 5-3-2 Iron Condor strategy, and I introduced that about a week or two ago, and then gave my conclusion on that it was a very profitable strategy, and now we're going to try to improve upon that. And in this iteration, what we're going to do is we're going to try to improve the amount of profit you can make by using the same amount of collateral. So basically improving the ROC, return on capital. It's going to be about a $16 base profit per Iron Condor up to about a $21 profit per Iron Condor. So we're still looking for the 5 delta on both of the short strikes, both the call side and the put side. But in this iteration, we're going to be having the widths of the wings only 1 strike wide instead of 3 strikes wide. So your long options are 1 strike further out of the money. Still entering Monday, Wednesday, and Friday for 2 DTE Iron Condors. And we're going to be getting approximately $7 in credit per Iron Condor. And I am calling it the 5-1-2 iteration. So 5 delta, 1 strike wide, 2 days until expiration. So just to recap, on the bottom is the setup for an Iron Condor. Short strikes are on the bottom, long strikes are on the top. And on the call side, we want a 5 delta, which gives it a 95% chance of being profitable, and then a 5% chance of it touching or at least expiring in the money. So that's where we don't want the price to be. On the put side, the same thing. 95% chance of profit is approximately a 5 delta, so a 5% chance that it expires in the money. And we want our underlying price to be in the middle of our short strikes. That's the idea of the Iron Condors. So with 100% of the distribution of prices minus 5% on either wing, that gives us a 90% chance that this Iron Condor would be successful if it's set up in this manner. So this 5-1-2 strategy, once again, it should get you about $7 in profit per Iron Condor, but because the widths of the wings are narrower, they're only 1 strike wide, and I'm using the Qs to set this up and test it, that's only $100 in capital. So you're getting about a 7% return on your capital, $7 for every $100 that you are putting up. Now, these profits are small, but they're going to be very consistent because we have such a high chance of profit. Now, I got this idea from a comment that I received on one of my previous videos. And the comment was, wouldn't it be better play $1 range and gain more money by buying, well, in this case, selling more contracts or Iron Condors? So instead of going $300, since your delta is fairly safe. And I completely agree. And that's exactly what I'm showing here. We're going to do a $1 wide range or $1 width on either wing, and then just selling more Iron Condors. Instead of just 1, we could sell 3 for the same amount of capital, but the deltas are the same. So the chance of profit is going to be the same. So here we can scale up to sell more Iron Condors for more profit. So in the 5-3-2 iteration, it was 3 strikes wide. That means it cost us, or at least we had to put up $300 in collateral, but we were only receiving $16 in profit. Still a good, profit, but only $16. But using $300 in collateral. In the 5-1-2 iteration, we're going to use $100 in collateral, but potentially make $7 in profit. So if we did that 3 times, sold 3 Iron Condors for $300, to make $21 in profit. So here you can see this compare $21 for the 5-1-2 strategy, because we sold 3 of them, versus $16 in the 5-3-2 strategy, because we can only sell 1 of them. Okay, so in both cases, we're using $300 in collateral, but in the 5-1-2, we're making $5 more in profit. On average, we're making $5 more in profit. So the potential max loss for an Iron Condor is the width of the wings in terms of strikes minus the credit that you received. So in our case, it would be $100 minus $6. So that would be a $93 potential max loss. That's what your broker is going to show you. That's what a profit and loss graph is going to show you. $93 in max loss. However, we should never take the max loss, because with this strategy, what I propose is that when the underlying ticker, in this case the Qs, touches one of the short strikes on either the upper call side or the lower put side, once it touches the short strike, that's when you exit. And so that actual max loss is going to be much lower than the potential max loss that you see on a profit and loss chart. Now, how do we determine that? I've been determining it using option strat. And so let me show you how I set up the 512 iron condor. Then we'll go over into option strat and I'll show you what that actual max loss would be with this particular iron condor iteration. Okay, we're looking for the Qs. And here we are, triple Q. So we'll go to trade options. It's Friday, so we're going to go to Monday's expiration, and we'll start on the put side by selling a put, looking for approximately 95% chance of profit, and we're trying to get something that is close to 5 delta as possible. All right, not that one. Let's see, this one, 251, not that one. So we'll go with the 250, and then we'll buy one strike further out of the money, which is the 249. Now we'll go to the call side, sell a call for about a 95% chance of profit. This 269 looks perfect. So we're going to sell that one, and then we're going to buy one strike out of the money, which would have been 270. So you can see this says $5 in total credit. When you look at the bid, it's going, 5, 4, 5. We're going to go 1 cent higher. We're going to go for 6 cents, and let's see what happens. We should get filled pretty quickly. And yes, we got filled. Okay, so $6 for this iron condor. Okay, now what we want to do is head on over to option strat and start with an iron condor. And we're going to put in our ticker, which is the Qs. Get rid of that, and then put in our expiration. And then now we're going to set our strikes as you saw what we did in Robinhood. Okay, so that was the 250 and 249 on the put side, and I believe this was a 269, 270 on the call side. And now we're going to enter the prices that we actually paid for or sold these for. So I'm going to do that right here. The 250. Okay, so those prices are in. You can see the net credit is $6. The profit and loss, doesn't look that good, but let's take a look now at the table. And what I'm trying to do is I'm trying to find out in the table when my short strike gets touched. And at the time of entry, so the 250, it's minus 35, the 269, it's minus 38. I take the greater of the losses, so that's minus $38. So that is my actual max loss that I should be taking, $38. Okay, so we saw that the actual max loss was $38. And again, if everything else is equal, that's probably the most that you are going to lose once your short strike gets touched. Is as soon as you enter it, there's a catastrophic move, and your short strike gets touched a minute after you sell this iron condor. Yeah, that's when you're going to lose all of that. But because we're selling options, the premium goes down continually. That's theta decay as we get closer to expiration. So that actual max loss gets lower and lower as time passes. So right when you enter is when that max loss should be the greatest. Of course, there are other factors. There's many other factors, but if everything else is equal, that's when it should be greatest. So you can see the max loss of $38 is much lower than the potential max loss that our graph was showing us, which would have been, in that example, $94. So when are we exiting? Well, with only 2 days until expiration, we just let these expire. That's the ideal scenario. And as long as the price stays far away from the short strike, we should be good. Now with Robinhood's early closeout process, if it gets close to the short strikes, you may encounter an early closeout of that side of the iron condor. So you could be in profit or you could be losing a little bit, but you just have to be aware of that. And that's something that I'm trying to work on my next iteration of the iron condor strategy, is to get around that early closeout dilemma with some of these iron condors. Because we're taking these all the way until expiration, what you'd want to do ideally, and this is what I do, is we enter the next iron condor before a current one expires. So this is just going to require a little bit more capital. You could exit early, and you would do that when the underlying price touches your short strike. That would be your actual max loss. There could be an early closeout by Robinhood, but if you're only selling this for, in this case, $6, sometimes $7, which is the average that I've been finding, then you're really not making that much money. And would it be worth it if you're trying to just exit at 50% max profit or 75% max profit? That's up to you. For me, it wouldn't be. Again, that's another thing that I'm trying to work on in my next iteration. So what I've been calculating is that the actual max loss on average is about $41 per iron condor. So in our example, we got $6 in credit, which I've been finding is around $7 on average, and we were going to lose $38 if our short strike was touched immediately. But on average, I'm finding that it's about $41. So $7 gain, $41 loss. Again, that's not a great risk to reward ratio, which is why I'm continually improving this strategy. But the main focus of this video is just to show you that at least we are making steps in the right direction. So I think the 5-1-2 is better than the 5-3-2, but to confirm that, I'm running 10 more iron condors, and in an upcoming video I'll go over those 10 trades and I'll let you know if indeed it is better than the 5-3-2 strategy. So please subscribe so you can get notified of when that video comes out. So in the meantime, if you have any questions about the 5-3-2 or the 5-1-2 or iron condors in general or selling options, then go ahead and leave a comment down below, and I'll try to get to it as soon as I can. Until next time, trade wisely and take care.